Thank you, everyone. Thank you for being here. This is my name is Randy Howell, Trader State of Mind, and what I want to do is I want to welcome Tim Racette, and we're here to listen to Tim, and just to kind of give you a sense of Tim. Okay, I met Tim online at one of these meeting places where everybody discusses trading and stuff like that, and I'm always putting articles about trading psychology on it and stuff like that. And over the years, I kept having this guy come in and making perfectly really good sense, okay, which is unusual because there's other trader trainers, there's other people and stuff like that, and they don't necessarily make very good sense. But I kept hearing this voice, Tim Racette, that every time he spoke, it was really grounded. It made a lot of sense. And I thought, well, that's interesting. And then we finally met, and what happens is Tim is going to be talking about basically about having a much more whole life and having trading as a part of it and being able to build trading as investing as a way to build a life. And so, you know, for me, you can begin to see why I'm so interested. And here's the quote that I like most from Tim, okay? Trading is not a way to get rich quick. It's a hard way to make an easy living, okay? So I'll tell you what, Tim's a young man who has been able to put this together early, and out of that, I think all of us need to listen. So what I'm going to do is I'm going to introduce Tim. Tim, you are on, and you have the mic.
All right, thanks so much, Randy. I appreciate it. I'm going to go ahead and flip over my screen so everyone should be able to see a nice photo of myself there. Again, my name is Tim Racette, and thanks, everyone, for tuning in to today's presentation. Thanks for Randy and Trader State of Mind for hosting the webinar. Today I'm going to talk about how to combine investing, swing trading, and day trading. And those three pillars, if you will, I kind of put together in a three-tiered approach to result in a very well-rounded and very balanced trading approach. So as always, before we get started, there's a little bit of housekeeping. Trading and investing does carry a high level of risk, and you are subject to lose all or more of your original investment. So don't trade with money that you can't afford to lose or money that, if lost, would affect your current lifestyle. The information in the presentation today is for educational purposes only and is not intended to be financial advice. So let's jump right in. We'll go over a couple of the things that we're going to talk about. I'll give you a little bit more background about myself, and then we'll kind of elaborate on the three different pillars. So to begin, we'll be talking about becoming a complete trader and what it means to do so, and to kind of walk you through the process that I use and some of the things that I've incorporated into my trading and my investing over the years. So it's really about balancing trading, work, and life, and kind of compiling all those together in a very homogeneous way. So we'll talk about some long-term retirement aspects. We'll talk about the short-term trading as well. We'll go into some specific strategies and things like that for swing trading and day trading. Another thing we will touch upon is kind of how you can do your own fiscal assessment and kind of walk through where you stand and formulate some goals and things that can help to lay out a plan for your trading and for your investing. So we'll talk about those three pillars, those three tiers, swing trading, day trading, and investing. And then we'll talk about some of the strategies and how those strategies apply to the different time frames, as well as some of the different methods that you may want to use for investing, that you may not want to use for day trading, and vice versa. And then I'll conclude with some tips as well as some common pitfalls that I've come across along the way. So I always like to begin my webinars with a little bit background about myself, so you can get a sense of who I am and kind of where I've come from. So I feel like I'm a very well-rounded trader, and I'm an investor, both in the stock market and other areas as well outside of stocks and bonds and things like that. There's real estate, there's gold, there's art, there's all sorts of things that we can invest in. I began as a swing trader, swing trading equities. Then I moved into options, and then shifted over, or added rather, day trading the futures markets, and then from there even the options on futures markets. But through that entire process, I've developed more than a methodology, a mindset, if you will, and hence the when I blog over at eMiniMind, it's more about sharing not just the things I've learned and the strategies that I use and have come up with over the years, but really sharing my thought process and how I think about the markets in that way. So I grew up in the Chicagoland area, and now I'm based in Madison, Wisconsin. I lived in Arizona for a while, attended Arizona State University, and I'm going to go ahead and let's see. Okay. I don't have access to the question window, but I know that a lot of people are going to ask if the webinar is recorded. It will be. I like to try and get through some questions during the recording, but if you do come up with something, you have questions throughout the presentation, you can go ahead and jot those down, make a note, and you can feel free to, I'll put my contact info up there at the end. If you have a question for either me or Randy, you can you can contact us after. We'd be happy to answer your question. So outside of trading, I race mountain bikes, and that takes up a good chunk of my time outside of the office. It really is a nice way to get away. I end up doing a lot of traveling and things like that, and being able to handle a lot of my trades and things like that in the evening hours, and then really focus my day trading portion to a smaller chunk of time during the day really helps me kind of balance things out. So I'm not just stuck sitting in front of the computer for 10, 12, 16 hours a day as it was when I kind of first got started. And I've had the pleasure to speak at the Traders Expo a number of times, as well as give some other presentations across the interwebs and things like that. And I always enjoy meeting some of my readers and some of the people that I've met online over the years face to face. And as was the case with Randy, finally got a chance to meet last February. So with that, let's go ahead and jump right in. The first thing that we'll begin with is, what makes a complete trader? And I think the first thing to think about is trading. Let's see, there we go. Trading with the end in mind. And you really want to begin by defining the goal, if you will. And for a lot of people, the goal when they think about becoming a trader or starting a new endeavor is financial freedom or retirement. So what do these two things mean? Retirement and financial freedom. Well, they're different for a lot of people, but really, retirement is just a sense of living off passive income, living off of the interest from the investments or the businesses or real estate that you've accrued over the years. So that's kind of the bigger goal and the bigger guiding star, if you will. So then when we look at trading, and whether it's day trading, swing trading, investing, all of these things, we want to try and integrate those with that larger goal of becoming financially free, getting to a point where we can generate income from our trades, generate income from our investments, so that we can live off our trading, quote unquote, quit our 9-to-5 jobs, as a lot of people come into trading with that goal of quitting their job. But really, it's more about building a sustainable and financial retirement, or a financial future. So really think of it as you're becoming your own money manager. And we'll get to some of the specifics in a couple of minutes. But I just like to kind of begin with a little bit broader top-down approach. So we'll talk about kind of putting together a comprehensive plan, and you really want to separate accounts and have accounts with specific purposes, and then we'll go ahead and define a focus for each strategy that we'll be kind of plugging into each of those accounts. So the first place to begin is kind of taking a snapshot, or doing a fiscal assessment of where you are right now, and really where do you stand with your finances, because that gives us a good not only a starting place, but then a platform or direction to go towards. So some questions you might want to ask yourself: how much are you bringing in each month, and how much do you have saved, and how much do you currently have invested? And then from the other side of it, we have the income side and then the expense side. Where is your money going? Where are your current expenses? And when I bring some of these topics up, sometimes people ask me, or they say, well, how does this really apply to trading? Well, there's a lot of psychological pressures that we have from current expenses that we currently have, pressures from all sort of areas, different aspects of our life that then weigh on us when we sit down in front of the computer and trade. So I've found, especially for me personally, that walking through these kind of exercises really help kind of build a framework and give me a nice platform and foundation to launch off of. So when you look at the income side and then look at the expense side, there's a couple of worksheets from a couple of books that I found somewhat interesting, somewhat helpful. Tim Ferriss's 4-Hour Workweek has a couple of good Excel sheets and tables. There's also another blog that I enjoy reading that I've probably some of you have heard me mention on my own blog, the Mr. Money Mustache blog. And as well as the Marketplace Money podcast. I think those are, 3 very interesting aspects to money and the approach of retirement, and they can have a, just getting a fresh perspective, I think, really helps. So a couple more points, and then we'll move on to more of the trading aspects. But if you're thinking about, okay, well, I want to, use trading and investing as my means for retirement, for building wealth, so that I don't have to essentially work. I can have my money work for me. Well, a quick and easy calculation is to just take your yearly expenses times 25, and that number will give you the result of the net worth that you would need to sustainably yield a 4% withdrawal rate. So in this regard, you can kind of set a goal and then develop a plan around that. And then we can begin to plug in different strategies for day trading, swing trading, and investing to kind of facilitate that, or help that goal along. So the next thing to get into is really the time frame and the different methods to plug in to each of the 3 tiers. So the first one, continuing top down, is the long term, and that's really your core. And so this is all about developing that net worth that's going to grow steadily over time. And the time frame for the long-term portion of the plan is years. And this is a lot of you probably already do investing in stocks, ETFs, and mutual funds, but really, building that core and that framework. And then the next tier is that intermediate, and that's really the growth and speculation. That's where we're taking advantage of different trends in the market, focusing maybe on some specific sectors, and I look at this as weeks to months. So, swing trading falls into this category, and I will look to swing trade stocks, ETFs, and even options as well. And then when we get down to the short term, well, the short term is used for generating income and hedging some of the intermediate time frame positions. So here, the goal of the short-term trading is to generate weekly returns and hedge those longer-term positions, albeit around smaller or news announcements or things that are occurring in the market that may have short-term impacts that we may want to capitalize on, but at the same time we don't want to close, or we don't want them to affect our intermediate term and long-term positions. So here in the day trading realm, in the short term, that's where we look to capitalize. And this is really everything from the minutes up until a few days. And with day trading, I look to the futures markets. I also, the weekly options have been something, as in the last couple of years, that have really come a long way. And then there's always day trading stocks as well. When it comes to dividing up these three tiers, okay, so we've looked at how much money we have, what our current net worth is, and we've decided, okay, we're going to kind of break our investing up into three buckets or three tiers: that long-term, the intermediate, and the short-term. Then how do we go about taking the money that we have, the assets that we have, and kind of plugging them in? So this is just kind of a starting point. You can certainly move the numbers around as you wish, but for the long-term investing, I'll use closer to 70%, putting a bulk of my money into the longer term, and this is contributing weekly and bi-weekly to really growing that core. And I personally look to the Vanguard funds. There's a handful there that I use. And then when I get down to the intermediate in my swing trading, this only ends up being about 20% of my total net worth. And this is just following simple trend trading strategy with a basket of stocks. I'll get into a couple of the specifics in a couple of slides. And then for the short-term day trading, well, it's what's left over. It's that 10%. And I'll look at a handful of futures and options markets. But really with the day trading, it's very focused, only a couple of markets, and I'm not looking to bet the farm, so to speak. So you could do you could switch things around. Instead of the 70-20-10, you could do 60-30-10. You could do 60-65. You can kind of change the numbers a little bit, but I think this kind of schema works really well, because you're not you could have a complete catastrophic failure in your day trading portion, and you still have your intermediate and your long-term kind of core as your backbone. And I found that as the long-term grows, the smaller time frames, the day trading and the swing trading, you begin to build more of that financial security, albeit just from the mental aspect. But it does, I've found, make it much easier to trade on the smaller time frames when I have built up my longer term core over the years. So, okay, well, what trading styles work best? So for day trading, a couple of styles that I use are trading breakouts and retracements. And I will look at the European and the NYSE that kind of cash session overlap in the morning. So that's anywhere from 7:30 to 10:30 Central Time, where you have the European markets that are still open. The New York Stock Exchange is about to open, and then it opens, and you have a lot of volume in the markets. There's a lot of eyes on the markets at that time. So that's kind of the section of the day where I do most of my day trading. And so you can see it's not a very big chunk, but what it is it's very focused, and I will look at typically the E-minis, the ES, the YM, the Dow, so the S&P, the Dow, and the Euro. I'll typically look at those three. In the past, I've looked at soybeans as well, and that's more of a seasonal trade. But a handful of markets in a very narrow window, and that's just another one of those things that really helps kind of keep things balanced. It keeps me from getting sucked into sitting in front of the trading screen all day, and losing my rhythm after 3, 4, 5 days of sitting in front of the screen for 12 hours. You can really drive yourself into the ground sometimes. So that's the day trading portion. With the swing trading, I like to look at a little bit longer term, so we're talking days to weeks, and then looking at more of a trend following methodology. And I will again use breakouts, and I will look at stocks that are making 52-week highs and 52-week lows, and look at those stocks in relation to the market. So I'm always recording, what stocks are breaking out and what stocks are breaking down, and then, what's the market doing? If the market's moving sideways and stock XYZ is breaking out to new highs, well, I consider that a stock that's relatively bullish or relatively strong to the market. And I usually bring everything back to the S&P 500 for easy reference. And same thing with, if the market's moving higher and stock ABC is selling off to new lows, that stock is, relatively weak to the market. So if the market were to make a downturn, I look for those stocks that are relatively weaker to move lower faster, and stocks that are relatively more bullish than the market to move higher faster, or be more resilient when I'm long of a stock and the market begins to pull back. If that particular stock is relatively bullish, I'm looking for that stock not to pull back as far. So that's kind of a little outline of how I go about the swing trading aspect. And then, it's just a matter of aligning the trading strategies with the time frame. So with the trend trading, you're not looking on a minute chart. You're looking on in my case, I look at the daily chart. And, it really, you want to tweak or modify or develop a strategy that, allows you to sleep comfortably at night. And if you ever feel like you can't sleep, or your heart's racing, or you get in a position, and as soon as you get in a position, it seems like everything goes out the window, all of your planning and discipline is just lost, well, you're probably trading too big, and it's important to kind of scale back a little bit. And then you want to make sure that the method that you're using and the bucket that you're putting it in, whether it's long-term, intermediate, or short-term, that it fits with your risk capital. So kind of aligning those allocation percentages that we just talked about, the 70, 20, 10 in my example, mentally, if I'm going into my day trading session for the day and putting in a couple of risk parameters in place so that I can't really hurt myself or hurt my account, and at the same time I know that the risk capital is only 10% of my net worth, I have a much easier time pulling the trigger. There's not as much hesitation. Well, there's no hesitation now, and I found that by scaling back and keeping things small, keeping my position size small, and really keeping that risk as low as I can, I'm able to trade the most effective. And that was just a matter of trial and error over the years, growing and scaling my trading, especially with the futures markets, because it's just a matter of adding another couple of contracts, and it gets to the point where things get a little bit too big, and as you're entering a trade, you may feel calm at the beginning, but as soon as you enter the trade, your heart starts beating and racing, and that's a time when you need to scale back, close out of the position, and kind of reassess your risk capital, or your risk tolerance in your size. So some swing trading methods.
Tim.
Yes,
We've got
Randy.
some questions.
Okay, great. Yeah, I don't
kind of trying to
have
figure out
access to
how to break in, and are you okay breaking in with some questions?
Yeah, that's fine. I don't have access to the window, so
I know.
go ahead and ask away.
I'm going to read it to you.
Okay.
Here's the first question, and this is from Bruce. Can you please share on what you have done personally on setting up a tax equity entity for your 360-degree view to investing and trading business? Now, that may be something you want to hold afterwards, or you can go for it now.
Yeah, well, now that it's fresh in my mind, thanks for the question, Bruce. And yeah, that is actually a slide that I didn't have in here that is a great question. So the way I have things set up, so I use Thinkorswim to handle my stock positions, options, and retirement accounts. And so those accounts are all in my own name personally. So my IRA and my brokerage account, those are my personal accounts. And my futures accounts and my swing trading account, those are in a business LLC. So those I have set up as Racette Capital Group LLC, and all of those assets are housed in the entity. So the investments are in my own personal name, and then the swing trading and day trading are housed under an entity, just a very simple LLC. And for tax purposes, it does make it a little bit easier in terms of recording all of the trades at the end of the year. I pretty much just print out my monthly summaries for the futures accounts, and then for the swing trading accounts, Thinkorswim will send me a cost basis at the end of the year, and I give that to my accountant, and he takes it from there. So good question, Bruce.
Okay.
Was there another one, Randy?
There's more. Go ahead. There's more. And this question is from a set of initials, and he says, do you run a trading room?
I don't. I did last year, last summer. I tried the trading room, and I found it was a little bit distracting, narrating my trades and things like that. I've done sessions every now and again, but I kind of found it a little bit distracting, and so I discontinued that after a couple of months.
Oh, I don't blame you. I think this is the last question right now, and I can't see who this is from, but I would love to get a copy of the PDF of the presentation so that I do not have to do screenshot saves. Can you send it to me in addition to the recorded video link? Thanks.
Yeah, absolutely. And I should have mentioned that at the beginning. I can send out the PDF with all of the links and all of my notes along with the recording, so you guys have that. So don't feel like you have to write down every little thing or record every screenshot. So yeah, great questions, and feel free to break in again later or at the end, and we can go with some more questions, Randy.
Okay, that's it for right now.
Okay. Well, let's jump into expanding a little bit on the swing trading methods, and then we'll expand a little bit on the day trading methods. So with the swing trading, I was talking about how I do a lot of my prep in the evening, and I'll use a very simple scan on a tool called FinViz, just finviz.com, and you can set up all sorts of different scans. And I'll look for stocks that are making new highs and stocks that are making new lows. And then after a couple of days, so I'll record those stocks in just a very simple Excel spreadsheet chart, or list rather. And then after a few days, I'll go back to those and look at those stocks that had previously broken out. And once they pull back, I'll look to enter long. And the stocks that broke down, I'll look for a little bit of a bounce and then enter once again and anticipate another leg lower or higher in the case of long. So I'm doing most of my analysis in the evening. I'm sifting through my watch lists, and I kind of have things down to a very strict routine that I can get through in 30 minutes if I need to. And I just go through and calculate the entry and the exit and the position size. And from there, I can just set my orders. And then the next day, I already know exactly which positions I'd like to get in, and I'll just monitor the first hour and the last hour of the day. I'll monitor those swing positions. And then from there, it's hands off. I'm just looking at the daily chart. I'm not breaking it down to the smaller time frames. That's really what the day trading aspect is for. So to be able to go into a position knowing that this is a weekly trade, or this is a swing trade rather, not not going into a day trade and having that day trade start to go against you, and then changing your mind and saying, well, no, now it's a swing trade, and I'm just going to hang on until it comes back. That's a really bad habit to get into. So by setting up 3 different accounts, the longer-term investing account, brokerage swing trading account, and then a day trading account, whether it's an options account or a futures account, you can go into each account each day with a strategy in mind. And you may not even touch your swing trading account for days at a time, or investing account rather. And you may decide that day trading isn't for you, and you're just going to break it down into a longer term, maybe an IRA and an investment account, and then a shorter term swing trading account. But at least having those buckets set up, having those tiers, you can go in with with a focus for that account and that strategy. So then the risk management that I use for swing trading, in terms of position size, how many shares, it's an equation probably a lot of you know. Instead of just saying, well, I'm going to buy 100 shares of every stock that I purchase, I look at the difference between the entry and the stop and factor that into how much I'm willing to risk. So if I have a $10,000 account and I'm comfortable risking 1% of that on each trade, it gives me $100 risk per trade. And if the distance between my entry and stop is $5, I just take 5 into 100, and that gives me 20 shares. And so that tells me how many shares I can go ahead and buy that will leave me with a $100 risk per trade. So that's how I calculate the shares. And then one thing that I look at that I don't hear a lot of people talking about, but I think is important, once you're in a position, if you haven't moved that stop to break even, or if your stop is still at your stop placement, well, you still have that $100 risk exposure. So if you put on 5 positions, your max risk exposure is $500. So that's something to really take into account. So in this example here, if you had 4 new positions on all at once, each risking $100 per trade, you end up with a max risk exposure of $400. And so if you wanted to limit yourself to a max loss, you want to take a look at that max risk exposure. Because if you put on a position on Monday and risk 100, and put on 2 positions on Tuesday and risk 200, and you forgot about the position you put on Monday, you still have that $100 at risk. So, if you have 2 positions on, and they've started to go in your favor, and you've had the opportunity to move your stop to break even after a week or a few days after the stock has started to move away from your entry. Now you could put on 5 new positions and have a max risk exposure of $500. So I guess this all comes back to the question of, well, how many positions should I put on? And my answer is, how much are you willing to risk? How much max risk are you willing to take? So if you put on a couple positions one week and you get stopped out on one, and a couple of the other ones start moving in your favor and they move to break even, and now the only positions you have, your risk is at break even, so theoretically 0, you could put on 5 new positions and still be within your risk parameters. And then the other thing I like to think about is looking at the delta, or the directional exposure. So you have to look at kind of the net of your positions. It's a little bit easier to do with options when you have just an option portfolio, but you can do it in the same way with stocks. And you're just looking at, what's your broader view of the market. If you're bullish, I look to have more longs in my portfolio, more delta positive. So I always like to be balanced in some sense. Maybe if I'm really bullish on the market, I might be 80% long and 20% short within my swing trading portfolio. If I'm kind of neutral, or if I'm bearish rather, then I would have maybe 30% longs and 60% shorts. And if I'm indifferent or neutral, then I might be about 50-50, or maybe I'll only have 1 or 2 positions on. But all of this is encompassed within the swing trading portfolio. So each position in itself gets assessed kind of as a whole in the swing trading portfolio, and then that swing trading portfolio also fits within the larger picture of kind of those 3 tiers or 3 buckets. So that's kind of how I look at swing trading. And then with day trading, some considerations or things that I take into consideration. Where is the advantage as a day trader? Where is our advantage for, a lot of the people I talk to are independent traders, at-home traders, not necessarily trading at a firm or a prop firm or a brokerage firm or something like that. And our advantage is not necessarily to be able to scalp for pennies on the dollar or to take a tick, out of the ES, because there's a lot of firms out there that have much higher capacity computers and technology. Well, our advantage is really to get in and out in a small window, and we can do that repeatedly because, especially on some of these larger, highly liquid markets like the ES, the Euro, you can get in and out with relatively small size. Even 50 contracts is small for the ES and for the Euro. You're not really going to push the market one way or another. So being smaller independent traders, we can get in and out of the market with ease and jump on board to some of the things that are happening by the larger institutions. And if we can jump on board and get in and out without pushing the market, that's that's really a great benefit, and that leads us to an advantage. So the smaller time frames are beneficial, but you want something that's more than just noise. For me, I found like the 1 and 2 minute charts to be just really too small. So I'll look at a 512 tick chart, which may be a little bit new to a lot of people. I'll look at the 3, 5, or a 15-minute chart, sometimes on different time frames, or on different markets. But usually my go-to is the 5 and that 15-minute. You can look at an hourly chart, but that's almost getting a little bit too big for day trading in a very small window of a couple of hours. And that window that I mentioned before was 7:30 to 10:30 That'd be 8:30 to 11:30 Eastern Time. And then the markets that I'm looking at are the Euro, soybeans, even the Russell, and the ES, and the NASDAQ NQ, and the YM as well. And you don't have to day trade the futures markets. You certainly don't have to day trade at all. But if you decide that you want to day trade and you don't have a futures account, you can trade the corresponding ETFs as well, the SPY, the Dow, NASDAQ, Russell, same concept, and you can just trade smaller share size. There are some tax benefits with trading futures, but by no means is it the the be-all end-all. Then when it comes to risk management of day trading, I think the most important thing you can do is to calculate your expectancy. And this is something that Van Tharp talks a lot about in his book and in his works across the board. Trade Your Way to Financial Freedom is a pretty popular one that goes into a lot of depth on expectancy. And it's important to understand the bigger results of your strategy over time, going through and doing some testing, kind of formulating things, really simplifying as much as you can, pull out all the things that don't really apply or aren't necessary for you to get in and out of a trade, and clarify and simplify as much as you can. And then when you have 50, 60, 100 trades, you can kind of take that data and plug it in and get a expectancy, which I won't go into a whole lot on expectancy. I do have more about that on my blog. I know Randy's talked about that in length as well too. But it is something that's really important. So looking at the smallest capital percentage, and trading is so scalable that we can develop a methodology with 1 and 2 lots or 10 and 20 shares, and scale that up. And so when we crunch the numbers on the smaller size, it really helps, at least for me especially. I really like looking at the data and understanding the numbers, and that helps me continue to take all the trades that meet my criteria, because I know that over the longer term, over a larger statistical set, this is theoretically my my results or my returns. So it really helps with being available to the markets to take those risks, because you never, every time you put on a trade, you're taking a risk, but you don't know if the next trade is going to be a winner or a loser, or if your next 5 trades are going to be a string of losers, or your next 5 trades are going to be a string of winners. So if we start to let our prior trades and some of our biases influence our trading to the point where now we're just becoming extremely subjective and saying, well, I just don't feel like taking this trade because my last 2 were losers, then you start skewing the data set. And when you add a lot of that subjectivity in there and straying away from the little bit more rigid, methodical process of taking all the trade setups that meet your criteria, then that's when things start to spiral and go downhill. So one thing I do for day trading is limit myself to 2 stop outs per day, and if I hit 2 stop outs, then I'm just I'm done for the day. And it helps me, it prevents me from damaging my account at any given day. And then I also set a max weekly loss, such that some weeks, some days, the market's just not conducive to your style of trading or your setups, and that's perfectly okay. But what you don't want to do is continue to trade continue to trade and just watch your trading account just decrease because you're frustrated or you want to make that money back. So kind of using that top-down approach, going from long-term, intermediate to short-term, and the corresponding investing, swing trading, and day trading, what it really does is it helps to facilitate growth and limits the damage that you can end up causing yourself by kind of breaking things out into the three tiers and then making the core your investing portfolio and looking at it not in a way to get rich by day trading, but really plugging in day trading into the bigger picture. And in turn, I found that I trade better when I trade a little smaller. So some tips to get on track as we...
Tim.
Go ahead, Randy. We got more questions?
Well, I've got one question, and it's the slide from, not the previous slide, but the slide before that.
Okay, let me see if I can back up here.
Not the tree slide, but the slide before that.
There we go.
Okay, the question is, 1,212 ticks, is that your YM?
Is that my YM? I do look at the 512 tick
that
chart.
or YM? I'm sorry.
Yeah, you can. I'll use it mostly on the ES and the 6E. On the YM, sometimes there's not as much volume, so you can go to a 233 tick chart. And the tick charts is just, instead of looking at the markets in time, for example, after 5 minutes having a bar close, this is looking at the markets after 512 transactions take place, a bar will close. So for the lower volume times of the day and for the lower volume markets, you can go to a smaller time frame, but the 512 is pretty small as it is, so I wouldn't go a whole lot smaller than that.
Okay, continue.
So to kind of tie things together here and give you a few tips to get on track, the first thing that I always recommend is go through and do a fiscal assessment, gather all of your current statements and things like that, and write down all your expenses, and then kind of sit down and look through it and determine what's your retirement number. And that equation that simple math I mentioned before was just your current expenses times 25, and that's the number that if you had that right now, you could live off that, spending your current expenses for essentially forever, because you'd be withdrawing 4%, and over the last I think as long as they've had data on the markets, 4% has been a sustainable withdrawal rate. You could go down to 3% if you'd like, and just multiply those current expenses by 33 to be even more conservative, or less conservative. You could multiply it by 20. But just kind of giving you a guiding North Star, if you will. So from there, then you can map out a plan, and you can look to either start or grow your investing account. I think it's super important to just set up a bi-weekly contribution. If it's $100, if it's $500, if it's $20, just continuing to add to that investing account so it's just constantly growing. And then earlier in the presentation I talked about a couple of those Vanguard funds you can look to build up, build your account around. And then the intermediate account, really sectioning that out, not keeping your swing trades in the same account as your investing account is really important. And sitting down and saying, okay, which strategy am I going to use for my intermediate trading, and then which strategy am I going to use for my day trading? And then you can go ahead and just kind of plug in those methodologies for each account, and you may find that you look at your investing account once a month, and you look at your swing trading account a couple times a week, and you're in and out of the day trading account on a daily basis. But this way, at least you have kind of a very integrated plan or map, if you will, and then just looking at it as a business. You're running your own money manager, and you're running your accounts just as a money manager would, just like a business would.
Okay, Tim, we've got some questions.
Okay.
And first, he's going, can you please go back to the day trading chart? Need to know the tick goals per trade. That may be a sliding scale for you, but yeah, it's a question.
Tick goals per trade. I'm not exactly sure what that's asking. That might be something better for a personal email. I didn't catch who wrote that in, but feel free to maybe expand upon that a little bit, and then a personal email.
It's Bruce Wilson, but the thing is,
okay.
It's also, how many ticks are you trying to get per trade? I know that a lot of guys I work with, what happens is they're sitting there, and their tick goals per trade are based on market structure, and it just, like I said. Here's another one. What is appropriate for a new trader? What are the best instruments to begin with, and also what are some key guidelines for a newbie? And this is day trading. Now this may be more I would consider that more to be directed at the end of the presentation. But if you want to take it now, we apparently are close to the end anyway. So
yeah, we're just about wrapping up here. I only have 1 or 2 more slides, but really I think for day trading, like I mentioned, I started as a swing trader, and I learned a lot of valuable things, and especially the patience. I learned a lot from swing trading because I was only looking at daily charts and not looking at smaller time frame stuff. And then when I migrated over to futures and day trading, I think it's best to start with just one market. The YM is a really great market to get started on, and pick one method or one style of trading, whether it's something that you pick up that you kind of break apart and make your own in your own way. I think it is important to kind of break down the style, but pick one market, pick one time frame, and pick one method, and just focus on that. And then once you go through that process of kind of developing your method, developing your routine, then you can slowly increase your size. So you can expand vertically by size. You can expand horizontally by different markets. And once you've kind of gone through the process of developing a methodology, it becomes really easy to transfer that to different markets and then make changes. But if you're looking at 10 different markets and multiple time frames and multiple strategies all at once when you're first starting, I think that can be a little bit I know that can be really overwhelming. So just kind of focus in on one thing. So
okay.
One more.
Yeah, are you suggesting a dollar cost averaging into Vanguard's multiple mutual funds, or are you looking at doing value cost averaging into it? Are you doing it with a fixed weekly schedule or a change based on market behavior?
So for my entries into the investment accounts, it's from a pretty broad perspective. So if the market is pulled back quite a bit on a monthly chart, I might pull up a monthly chart and wait for a very simple higher low to be put in, and then add. So it really is your dollar cost averaging in it. I don't do it necessarily the same day every month. I'll kind of pick and choose when the market is recessed or when the market is pulled back a little bit. But there's a lot of studies on whether you do the same time every month or bring in a little bit more timing into it. And the main thing is you're just continuing to add and continuing to both add to the account and contribute to one or two or a couple of different funds over the years. And that's the only account where I will add money. I think that's really important as well to note that, the swing trading and the day trading accounts, I don't add to those. Those stay, stay the same, and they need to grow on their own. But the investing account, especially for I talk to a lot of people who are younger or just starting out, just starting to save for retirement. Really, it doesn't matter what age you are, but those regular contributions are really important because compounding interest is on your side then. So let's wrap up with just some common pitfalls. I think when you pressure yourself to make money or put all your eggs in one basket, it can become very detrimental. So I think it's important to kind of make the transition slowly. Start with a top-down approach, and kind of ease your way into it, and really focus on executing effectively, especially on the day trading front. And for those getting started, you might start with the investing, and then after a couple months maybe get into swing trading, and it may be a year or two before you even, or never, if you decide to kind of bring on day trading. But everyone has their own viewpoints and tendencies towards different styles and different time frames. Me personally, I really enjoy swing trading, but I find that being able to do all of them together really provides a nice balance. And I think it's important to just really accept that you'll make mistakes as you go, and just note the mistakes and try not to make them again. So you want to check your ego at the door. I don't really, trading is an interesting business. There's a lot of talk that goes on, and I think it's important to just kind of be as humble as you can, because the market can just cut your legs out from under you at any point. So I don't really discuss my positions and things with many people. I have a couple traders that I've kind of gone through the process with, that we chat on a daily basis. But when I'm out, I don't do a whole lot of talking about work kind of stuff. And I think another pitfall is really the lack of focus, or just bouncing around a lot. You really want to pick one style and stick with it, for at least a year. I think a lot of people, you can think of it like diets. In January, everyone joins the gym, and by February, there's only 20% left. Everyone, just gives up. So focusing and testing your discipline is important. And understand that we're all humans, and those first thoughts that come into your mind that might be, oh, I want to get out of this position right now, I want to take a profit, I want to close out. Those are the same thoughts that are going through a lot of other traders' minds, but it's the more seasoned traders who can recognize that thought and just kind of set it aside. And that helps me really think clearer and stay very focused. Is just not acting on my first tendency or my first bias that might come up. So think about who might be on the other side of your trade. If I'm long, there's going to be someone who's short on the other side, and what might their viewpoint be? Why might they be short? So just thinking in terms of the opposite of the other side, other perspective is really helpful. So one final note.
Hold on, we have
one thing I always say is
there's.
Okay.
Tim.
Go ahead.
We have a question, and this one actually may be more of a question that should be addressed to me, but I'm going to let you do this one. How do you keep your head straight when the market is going against your positions overall, and you get a setup to go against your positions and actually take that trade?
Well, if I'm in a position and I get a signal in the opposite direction, typically that would be an exit signal. But if the question is, do you take that trade in the opposite direction? So I'm long and the trade starts going against me and I get stopped out, and at that same time that I get stopped out, it's a entry in the other direction, I'll absolutely take the trade. I just have some very simple criteria, and if things meet, if the market meets my criteria, I don't really hold a bias going into a position. If I get in the position and it immediately goes against me and the market conditions change, the market conditions change, and you have to be able to kind of flow and adapt to those changes. So as soon as I'm out of a position, I kind of forget about it, and I'm already moving on to the next one. So there's no shortcuts for that substitute, or there's no shortcuts for the screen time that just going through the process and observing the markets and studying the markets and placing trades and making mistakes and things like that. But what you can do is really focus on working smart and being patient and really focusing on that discipline that you hear lots of traders talk about over and over again. But the more time and hands-on experience, the better. I know we all learn in different ways, but when it comes to trading, I think the best way is the actual hands-on experience. So I have a handful of different articles and videos and things I've put together over at my blog. It's eminimind.com. I started it based on talking about day trading and futures trading, and I've expanded to other things, talking about some different markets and swing trading and investing and things like that as well. So the start here and the archive tabs are good places to begin. Got some videos up there, a list of all the resources that I use, some other blogs and things like that. I do a little bit of one-on-one mentoring, not a whole lot. That's more Randy's and Trader State of Mind, their gig, the more one-on-one personalized stuff. And so I also have an ebook up on the website that goes through all of my trading rules and kind of putting together a trading plan. And for today, really I'll do it through the weekend. You can use August 8th as a coupon code to get 30% off, and then a month's access to all of the videos and archive webinars and bonus things and interviews and stuff like that I have on the blog. So if you have other questions that I didn't get to, you can certainly email me at tim@eminimind.com. You can check out the blog, eminimind.com. You can check out Randy's website, traderstateofmind.com. And I really just want to thank everyone for tuning in today and attending. I'm happy to answer any questions via email later on, and thanks again to Randy for hosting the webinar.